Right now, somewhere in America, a person is staring at their phone. Their banking app is open. They can see the number, their savings, the paycheck that landed yesterday, the rent money they've been protecting for 3 weeks. The number is right there. It feels real. It feels like theirs. It is not. And the unsettling part, the part that should make you pause whatever you're doing right now, is that this isn't a conspiracy theory. It isn't a fringe idea from someone on the internet selling gold coins. It is written, plainly and legally, in documents published by the United States Federal Reserve, documents that almost no one reads, documents that quietly describe a system most people never knew they were living inside. So let's talk about it, carefully, honestly, without drama, because the truth is interesting enough on its own. Let's go back to something you probably learned as a child. You earn money, you put it in the bank keeps it safe. Someday you take it out. Simple, clean, responsible. That is the story, and like most stories told to children, it leaves out the uncomfortable parts. Here is what actually happens when you deposit money into a bank. You hand the bank your money, and legally, in that moment, it stops being yours. What you receive in exchange is not your money sitting in a vault with your name on it. What you receive is a promise, a liability on the bank's balance sheet, an IOU. You have become, without signing anything that explains this clearly, an unsecured creditor of your bank. That word, creditor, matters because creditors don't always get paid back, especially when there's a line. And in a bank failure, you are near the back of that line. Now, before you close this video, let's be fair about something. The FDIC exists. The Federal Deposit Insurance Corporation insures deposits up to $250,000 per depositor, per bank, per ownership category. That is real protection. That matters. And for most Americans with standard savings, that coverage is relevant. But the FDIC itself, as of recent reporting, holds reserves that cover roughly 1.27% of all insured deposits. 1.27%. That means if a large enough wave of bank failures hit at the same moment, not an impossible scenario, as 2008 reminded us, the FDIC would need a bailout of its own, from Congress, from taxpayers, from you. The safety net has a safety net, and that second safety net is your future tax dollars. Keep that thought. We'll come back to it. Let's talk about where your money actually goes. When you deposit $1,000, the bank does not put $1,000 in a box. It takes your $1,000 and it lends most of it out immediately to a stranger. This is called fractional reserve banking, and it is the engine that runs the entire American financial system. Here is how it works in practice. Under the Federal Reserve's framework, banks are required to hold a fraction of deposits on hand as reserves. The rest can be lent out. For decades, that fraction hovered around 10%, meaning for every $100 deposited, 90 could be lent. But in March 2020, quietly, in the middle of a global pandemic, while every screen in the world was showing case counts and stimulus checks, the Federal Reserve reduced the reserve requirement to zero. Zero. American banks are now legally permitted to hold $0 in reserve against your deposits. This is not a secret. It is on the Federal Reserve's own website. The stated reasoning is that modern banking supervision and capital requirements less relevant. That may be true. It may also be the kind of technically accurate statement that obscures something worth understanding. Let's think about what this actually means. You deposit $1,000. The bank lends it out. That borrower deposits the loan into their bank. That bank lends it out, and so on. Through this chain of lending and redepositing, your original $1,000 can expand through the banking system into many thousands of dollars of loans circulating through the economy simultaneously. Economists call this the money multiplier. It is considered a feature, not a bug. Credit creation is what funds mortgages, small businesses, car loans. It is how economies grow. But here is the quiet irony buried in the middle of this system. The money that now exists, that circulating, expanding, multiplied money, it was never printed. There was no press. There was no physical act. It came into existence because a bank typed numbers into a ledger, because you deposited, because someone else borrowed, because both of you believed the number was real. And belief, it turns out, is the actual foundation of the dollar. Not gold, not silver, not reserves, belief. This is where the story gets uncomfortable, because belief is fragile, and history knows this. In 1931, a bank in New York called the Bank of United States, note, not an actual government institution, just a bank with a very official-sounding name, began experiencing rumors of insolvency. Customers lined up. They wanted their money, real money, physical currency. The bank didn't have it. It had lent it out. It had multiplied it. It had turned deposits into assets on paper. But paper assets cannot satisfy a crowd at a teller window. The bank failed. Over 400,000 depositors lost money. It was one of the largest bank failures in American history up to that point. That was 1931, before deposit insurance, before the modern regulatory framework. Fast forward to March 2023, Silicon Valley Bank, the 16th largest bank in the United States, with $209 billion in assets, collapsed in 48 hours. Not from fraud, not from recklessness in the way Wall Street movies portray it, from a bank run triggered by a social media post and accelerated by the speed of digital transfers. People moved money in minutes, not days, minutes. The digital age has not made the system more stable. It has made the speed of panic faster. Here is the part of this story that most finance channels skip. When Silicon Valley Bank failed, the FDIC stepped in. Depositors were made whole, including those above the $250,000 insurance limit, through a special government backstop. The message was clear. Don't panic. Your money is safe. The system works. And that is probably true for most depositors, most of the time. But let's ask a different question. Not whether the safety net catches you. Ask who holds the net. The Federal Reserve is the lender of last resort. When banks need emergency liquidity, they come to the Fed. The Fed provides it in exchange for collateral, usually government bonds or mortgage-backed securities. But where does the Fed get the money it provides? It creates it. That is not a metaphor. The Federal Reserve has the legal authority to create money by crediting accounts. It is the only institution in the United States with that authority. And when it does this at scale, as it did in 2008, as it did in 2020, the money supply expands. More dollars exist. Each existing dollar buys slightly less. This is inflation, not the kind you see at the gas station in isolation, the structural kind, the slow dilution of purchasing power that happens whether markets are booming or crashing. The money in your account, the number in your banking app, it represents a claim on a pool of dollars that grows larger and larger, diluted, quietly, every time the system needs rescuing. You keep the number, but what the number can buy, that's the variable no app displays. Now let's step back, because none of this means the system is evil. Fractional reserve banking, credit creation, is genuinely how economies build infrastructure, fund innovation, and generate growth. The mortgage that let your parents buy a home existed because some bank took someone else's deposits and lent them out. The loan that launched a small business existed because of this same mechanism. The system produces real things, real jobs, real houses, real growth. But it also produces something else, risk that is socialized while reward remains private. When the system works, banks profit, shareholders profit, executives earn bonuses. When the system breaks, governments intervene, taxpayers absorb, central banks create, and depositors, the unsecured creditors at the back of the line, are protected just enough to prevent panic, just enough to keep belief intact, because belief is the product, and the product must never be allowed to fail completely. There is a final layer to this that almost no one talks about in plain language. The entire structure, fractional reserves, deposit insurance, the Federal Reserve as backstop, the government bond market that funds it all, it is a closed loop. Each part depends on the others. Each promise is backstopped by another promise. Your deposit is a promise from the bank. The bank's solvency is a promise backed by regulation and capital requirements. The FDIC is a promise backed by government intervention. Government intervention is a promise backed by the ability to borrow. Borrowing is a promise backed by the bond market. The bond market is a promise backed by faith in the United States government. And the government's credibility is ultimately backed by, and we have arrived back at the beginning, the belief of the people who hold the dollars. This is not a house of cards. The system is far more resilient and sophisticated than that metaphor suggests. But it is a system built on confidence, and confidence is not math. Confidence is psychology. Confidence is the collective decision of hundreds of millions of people made every single day to act as though the number in the app is real. Most days they are right. The number functions, the economy moves, money works. But on a few extraordinary days in history, 1929, 1931, 1987, 2008, 2023, the question was asked out loud, is this real? Can we actually get our money? And in those moments, the answer was always, it depends on whether enough people ask at the same time. So here is where we land. Your money is safe, probably, for most practical purposes, under normal conditions with current protections in place. But your money is also technically a loan you have extended to an institution that does not hold it, does not need to hold it, and operates within a system where the ultimate guarantor is a government with $34 trillion in debt and a central bank that can create money but cannot create trust. The number on your screen is real the way all social agreements are real. It is real because everyone agrees it is real. It is real until it isn't. You were never told that when you opened your first savings account. No one handed you a pamphlet. No one explained fractional reserves or unsecured creditors or reserve requirement ratios. You were told, put your money here. It will be safe. And that is probably true, almost certainly true. True enough that the alternative, keeping cash in a mattress, abandoning the system entirely, is almost certainly worse. But there is a difference between trusting a system because you understand it and trusting a system because no one explained what you were agreeing to. One is informed confidence. The other is something else entirely. The question worth sitting with tonight is not whether your bank will fail. It almost certainly won't. The question is this: if the money in your account is technically a promise, a liability, a claim, an IOU, then what exactly are you holding on to? And who decides what it's worth tomorrow? Because that decision is being made right now, constantly, by institutions you didn't elect, using tools most people don't know exist, to maintain a system that functions best when you don't think too hard about how it works. That's not a conspiracy, that's a design. The only question left is whether the design still serves you.